This is our monthly webinar, and this month we are tackling kind of a broad topic of financial planning in general, but specifically we're going to highlight some things that might be specific to 2026, some changes rolling into the new year that you may want to be considerate of when you're kind of thinking about your own financial picture and making some decisions. So by way of introduction, if you have not joined us before, my name is Chris Thomas and joined by Micah Potashnik. And 40W Advisors is our firm. We have the privilege to serve as the retirement plan consultants on your company's 401k plan. So as part of our services to your company, to the 401k plan, we offer financial wellness, education, support, whatever you would like to call it, to you, the employees. So this is a valuable benefit that's made available to you by your employer. We really encourage you to take advantage of it. By joining today, you're taking advantage of one of the things that we have to offer. We're going to show you some of the tools at the end, some tools and resources we have available at no cost to you that you can use. And you always have an open line to reach out to us and talk one-on-one with any questions that you have. So before we jump in, a couple quick administrative items. One, everybody's currently joined in listen-only mode. So if you do have questions, and we really encourage questions, you can use the questions box or the chat box that's in the meeting control panel. And I'll kind of be monitoring those throughout. We'll try to get to your question right away. If not, we'll make sure that we get to it at the end. Secondly, everything we do talk about today is just for education and informational purposes only. So nothing should be taken as personal financial advice specific to you. For financial advice specific to you, you'll want to talk to a personal financial advisor, CPA, attorney, what have you. So with that out of the way, let's go ahead and jump in. And to start, I kind of wanted to just throw it out there and just acknowledge the fact that our financial lives are messy. I took this piece. This is a piece that we have in one of our decks for our personal wealth management side of the house of what we do. And what it does, it just kind of puts it all out in front of you, all the things that we have to think about, whether we realize it or not, things that we deal with in our personal financial lives. Some of this stuff on the left here, I'll just boil that down to managing a budget, monitoring our income, monitoring our expenses, and then doing our taxes. But then I think it's a little more self-explanatory when you look at all the considerations you have to make on an annual basis about our health insurance. Do we have disability insurance? Do we need long-term care insurance? There's all kinds of different insurances that we have to evaluate and monitor regularly. Homeowners insurance, auto insurance, all of it. Then we have to manage our debt. We got to be cognizant of what we have. Do we have high debt levels? Are we paying too much in interest? How do we reduce our debt? Maybe you have kids and hey, it's really expensive to send kids to college. Maybe I'd like to save for them. Retirement planning, you've got your whole issues with, I don't know anything about Medicare, Social Security. How much do I need to retire? And then you have people talking to you about estate planning. Oh, do you have a will? Have you updated your beneficiaries? Do you have a trust? So point being, it's messy. There's a lot out there. We all have a lot on our plate. So we're going to peel back with this today and in subsequent meetings throughout the year. We're going to try to just drill in and talk about some specific pieces of this kind of complex puzzle that we all deal with. Today, it's going to be a little bit on the higher level. So Micah, I'm going to bring you in here, let you kind of chime in and run the show for a bit. So why don't you just talk to us about what's changing?
Yeah, so there's a lot that's changing in 2026. That's why it's important to have these conversations at the beginning of the year so you can start planning accordingly throughout the 2026 year. So back in July of 2025, the One Big Beautiful Bill Act was passed, and that brought in some meaningful changes that impacted most Americans. Some of those changes went in effect immediately in 2025. You can see some benefits when you file taxes here, maybe an additional refunds or things like that. Others will take effect in the 2026 tax year, so we'll dive more into those. Contribution limits across different retirement plans change. So 401k contributions, IRA contribution limits increase. So we'll dive into those as well. And those can be really impactful, as those can help minimize your tax liability and potentially even help you be eligible for other tax saving mechanisms. Social Security, there's always each year a COLA adjustment, and probably very few of you might be impacted by the COLA adjustment today, but that's something that is going on each and every year. That's the cost of living effect. So it's pretty much an inflation adjustment to Social Security. And each year is always changes to Medicare premiums. Certainly, healthcare is a big part in society today, and a lot of discussion on healthcare as a whole. And so there's impacts on Medicare premiums, something called IRMA, which deals with additional premium costs you might pay if your income's too high. And those premium increases certainly impact planning for retirees. So that's very high level what's going on in 2026. So let's dive more into that one big beautiful bill act, which was passed in 2025. So there's some changes that will help impact and benefit many Americans. One is a higher standard deduction. So when you file your taxes, everyone's eligible for a standard deduction, depending on whether you're single, married, filed separately, filed jointly. You're eligible for a standard deduction across the board. One of the changes that occurred as well, if you are over 65 years old and make under $150,000, you're even eligible for an additional bonus deduction on top of that. So that higher standard deduction, very helpful. The child tax credit, if you have a child, you are eligible for a $2,200 tax credit for that child. That's increased from $2,000 previously. There are phase outs to that, so it's always important to monitor as your income becomes higher. If you're approaching those phase out limits, making sure you're doing things potentially lower your modified adjusted gross income to make sure you're still eligible for that tax credit.
Yeah, if you married, filing jointly, income over $400,000, you're not going to qualify for the child tax credit. I don't know. Maybe think twice about having more kids. It's one reason for it. So
there you go. Exactly. On the charitable side, so one of the big changes that occurred on the charitable side, and so we can, again, not to dive too much into tax law and how things operate, but starting in 2026, depending on whether you're single or married, filed jointly, you're able to get a deduction for either $1,000 or $2,000 of charitable gifts that are cash. Usually you had to itemize your you had to file for itemized deductions to qualify for any charitable contributions. That's changing in 2026, so everyone's going to be eligible for a little deduction if you make cash donations. One of the big changes that occurred, we talked about standard versus itemized deductions, is the SALT cap increase. So SALT stands for state and local tax deduction. So that includes things like paying state taxes, property taxes if you own a home. For the last few years, that SALT cap was $10,000. So if you were paying, $25,000 in state taxes, $15,000 in property taxes, that was $40,000 you're paying to your state and local governments. That amount that you're able to deduct on your tax return was capped at $10,000. And even taking a step further, unless you itemized your deductions, you weren't even eligible for that $10,000 deduction. So many people were just filing standard because very few qualified, and it made sense mathematically to file for an itemized deduction. That's one of the big changes in this most recent bill, is that increased amount for the SALT deductions now $40,400. So using my previous example, go ahead, Chris.
This is really going to help people who live in high tax states, and I know some of you do. We're in Maryland. Maryland's considered a high tax state, and I know some of you, California, New York, high tax states where you haven't been able to fully deduct what you pay in property taxes and income taxes to the state. You haven't been able to fully deduct that, most likely, in prior years. So this is a good benefit for that.
Correct. And so now it's going to potentially allow you to take that full deduction, which therefore allows you to itemize your deductions, which then leads in some additional tax deductions you might be eligible for. So that SALT cap increase was probably one of the most impactful things that came out of the recent.
And we're going to talk more about that in a second. So.
Exactly. And then the Trump accounts. So if you had a child starting in beginning of 2025 for the next couple of years, $1,000 goes in a Trump account. Again, we'll dive more into those in a minute here. And there are estate and gift tax changes. So if you're, now your estate, if you're married, until your estate's north of $30 million, you won't have any estate taxes, and you're able to contribute or gift to $19,000 to as many people as you want in 2026 without dealing with any sort of gift tax. So those are the big changes on the estate and gift side of the ledger.
But Micah, what we're going to do is we're going to dive in. We want to peel some of those back, and we're going to dive in and talk more about just really what we just talked about, this SALT cap, what that really means for some of you. Before we do, I wanted to do a poll earlier before I started, and I'm going to go ahead and just throw it up there now. So I just want to see, as I mentioned, our financial lives are pretty messy. I'm just curious. I always like to test the pulse of the people that attend, and want to see how often do you kind of check in on your finances. That could be just checking in on your budget. Think about it, checking in on, hey, how is my savings rate appropriate for my goals? So if I'm saving to buy a house, how is my savings rate? Am I on pace? If I'm saving for retirement, am I on pace for retirement? Am I on pace to have money for kids' college? All right. Thanks for doing that. I'm going to go ahead and close that. Share the results. As you can see, interesting. We've got about half the group does this pretty frequently, so at least quarterly. So that means you're checked in, which is maybe why you're joining us today. So good job. Hopefully we keep you focused. And then we've got, the other 50% either never doing it, or, we've got people doing it annually as well. So really no wrong or right answer there. Just wanted to get that feedback from you. So thank you, and let us know. A lot of you seems like you follow your stuff pretty closely. So let us know other topics you want to hear about. You'll have our contact information at the end. Happy to create presentations going forward on stuff that is of most interest to you. So sorry, that was a little bit of an interlude, but Mike, I'll let you take us back to the SALT cap.
Perfect. Are you able to?
Is it there?
I see the poll right now.
Oh, you do. How do I do that? Oh, there we go.
There we go. Perfect. There we go. Wonderful. So let's dive more back into the SALT cap again. Kind of gave the quick overview of what it is, but let's sort of dive more into the numbers, because as Chris and I mentioned, it's a pretty significant change and could certainly impact many of you that might previously have been filing for the standard deduction, but now might qualify for itemized deductions because the math now makes sense. So again, that SALT increase, that state and local tax deduction is up to now $40,400. But there are income limitations to that. So if you're, what's called MAGI, which is pretty much your adjusted gross income, which is pretty much your income minus what are called basic deductions, maybe like your 401k contributions, FSA, HSA contributions, those all adjust to your adjusted gross income. And there's some, what's called your modified adjusted gross income, which adds a few additional data points to that. So your modified adjusted gross income is what's utilized to determine, are you eligible for these state and local deductions, or do you get phased out? So if you're under $500,000, you're eligible for the full $40,400 cap. And why this cap is as high as it is, there are some strategies that you might look to implement to take advantage of making sure you're able to maximize your deductions. Because once you start itemizing your deductions, any sort of eligible item for itemized deductions gets added in and helps lower your adjusted gross income, which helps lower your taxable income. So one thing to do is making sure you're front loading, you're paying your property taxes in December versus January. So if you're by paying in December, you are able then to take a tax deduction for the current tax year versus waiting a whole year to take that deduction. Chris, looks like you want to hop in here.
Yeah, something that I don't think was called out there I want to make mention of is that, so this increase to the SALT deduction from 10,000 to 40,000 it's only in place until 2030. So you have, you know, four more tax years to take advantage of this. So that's why you want to kind of accelerate as much, if you're eligible for it based on income, which we're talking about now. You'll want to try to maximize this what you can, because in 2030, it's going to be capped again. As current law stands, it'll be capped again at $10,000.
Correct. So yes, that's why, you know, taking advantage is important. So again, strategies include, you know, front loading property taxes if you're able to do that. So you're able to take that deduction and why you're, you know, eligible for it. Other things, if you're someone that likes making charitable contributions, again, charitable contributions, other than that new rule where the first $1,000 or $2,000 is eligible, unless you itemize your deductions, charitable contributions are not tax deductible. You have to itemize to get the tax deduction. So if you're already itemizing your deductions because you're utilizing the SALT cap, potentially front loading some of those charitable contributions is really important. And there's some different types of tax strategies associated with it. Things like donor advised funds across the board. It allows you to front load contributions. And again, there's other itemized deductions that are available. So, you know, again, once you sort of start the itemized deduction path, looking into other itemized deductions to make sure you're kind of maximizing that bucket, filling that bucket up as much as possible is extremely important. Chris, anything to add to that on sort of the, you know, if you qualify for the SALT deduction?
No, I'll just, if you're under $500,000, you get the full 40,000. You know, you get the full benefit. You benefit the most. And I'll just quickly make the point that if that deduction, that $40,000 starts to come down once your income's at 500,000. If your income's over $600,000, you're back to the $10,000 SALT cap. So there isn't a whole lot of additional benefit for you. So what happens if you're kind of in this little gray area where, you know, you're around 500 or between 500 and 600? Well, maybe that's a year, if you know that going in, if you know what your income's going to look like, that's a year that maybe you make every, you know, possible way you can to get your income down. Well, can you defer income? Is there any way that you can defer income into another year? Can you make sure you're maximizing all of your pre-tax contributions, 401ks, HSAs, things that are available to you there? Minimize capital gains. Capital gains are taxes that you pay maybe if you bought NVIDIA stock 5 years ago and now you decide you want to sell it. Well, when you sell it outside of an IRA, when you sell it, you have to pay tax on the gains that you recognized in that investment. Those capital gains are added to your income. So be careful that, you know, you don't recognize a bunch of capital gains and throw yourself up over this $500,000 limit, which then could hurt, you know, a tax standpoint. I'm not saying every decision you need to make needs to be based on taxes, but I just wanted to just be aware of the fact that if you do sell investments, generate capital gains, that could jeopardize this. And also Roth conversions, the same thing. If you're utilizing the strategy of converting pre-tax IRAs to Roth IRAs, that creates additional taxable income that you're not going to want if you're in this, if you want to maximize, if you're in this tax bracket and you want to maximize your SALT deductions. So, and then if you're over $600,000, there's not a whole lot of planning you can do. So, Michael, I'll take Trump accounts just to run through it quickly. The Trump accounts, look, we threw this in there because people ask about it. It's made some headlines, people have questions, so we figured we'd spend a minute on it. What Trump accounts are is they're what's called custodial accounts. So that means there's a custodian, which is the parent or the owner of the account, and the account is for a child who is the beneficiary. So as the custodian, you are required by law to operate this account solely for the benefit of the beneficiary. So how these accounts work is they're after-tax contributions, so you do not get a tax deduction for the amount that you put into account. You can contribute up to $5,000 per year per beneficiary. So each kid could have an account for $5,000. Now, grandparents can contribute to that. Anyone can contribute to the account, but the most that can go into that account is $5,000 per year per child. For newborns, born in 2025 and through the 2028, the government will put a seed investment or $1,000 contribution to the account after the child's born. You have to go and you have to apply for that. Don't ask me how. I think you can Google it and find out, and it'll take you to some instructions. Once you have money in that account, there's no distributions from it before the child is age 18. And at age 18, it converts to an IRA for that child, which is then subject to the IRA rules. And because it's an after-tax IRA, it'll be taxed on any gains, so any appreciation, any investment appreciation in that account are going to be taxed when you take a withdrawal. And if you take a withdrawal before age 59 and a half, there's a 10% penalty. Bottom line, I don't know that, I don't see a huge benefit in these Trump accounts, other than the fact that if you have a newborn, like Micah does, in 2025 through 2028, you can reach out to the government, ask them for $1,000, they will put it into the account, and you can just let that $1,000 grow. There's lots of other accounts that have more flexibility that you can open for your child, that have better tax advantages and more flexibility that you can open for a child other than these. But this is where you can get $1,000 contribution. Micah, any?
Nope. Nothing to add.
So we just covered what really we thought to be the, some of the most applicable things from the tax bill. Here's the thing. When you file your taxes this year, if you typically get a refund, you're probably going to get a bigger refund this year on your 2025 taxes than you have previously. And the reason why is because we have these tax benefits that went into effect actually in 2025, but the withholding schedules were not updated in 2025. So the withholdings that you have from your paycheck were still being withheld, assuming the higher tax cost. So that's why you should see an increase in refunds. We think it's important that you know what your phase out ranges are, especially for that SALT cap. Know if you're close to that 500,000 and then make some considerations. Consider that $3,000 from the government if you had a child this year. And then if you are somebody that does charitable contributions, it's worthwhile to just kind of maybe take a look, do a little research, talk to some people about if you could be more strategic for how you do your contributions. Quickly, every year, the retirement plan contribution limits change. Here's a quick highlight. Most important for you guys, 401k plan, you can put an additional $1,000 into the 401k plan this year. So your maximum is $24,500. If you're age 50 to 59, well, if you're age 50 and over, you can do at least an additional $8,000. That's your regular catch-up contribution. And if you're between the ages of 60 to 63 as of the end of this year on 12/31, then you can do your catch-up contributions a little bit higher than everybody else's, and you can do $11,250. If you have people in your people in your family contribute to an IRA, those limits went up slightly as well. And then HSAs, if you're contributing to an HSA, those limits went up slightly as well, $4,400 if you're an individual, and $88,000 up to $8,750 for a family coverage for HSAs. So the real takeaway here is on the retirement plan side, review your contribution rates. If you've somebody that's been maxing out, then maybe you need to go in and increase your deferral percentage a little bit to make sure you hit the new maximums. Something we did not talk about, but mandatory Roth catch-up contributions. So everyone should have gotten notifications of this new rule that if you're over age 50, meaning you're eligible for catch-up contributions, and you earned over $150,000 last year from your employer, then those catch-up contributions that you make in 2026 are going to have to go into a Roth account within the 401k. They cannot go into the pre-tax account as they could previously. So that's a big change for 2026. We've communicated that out through the 401k channels quite a bit. Hopefully you're aware of it. If you have questions on it, feel free to reach out. And if you are subject to that limit, then maybe you just contribute and you really want to maximize tax benefits, then maybe you can look for other ways to save pre-tax other than doing it through catch-up contributions. So Michael, you want to jump in here? I'll turn it back to you and just kind of, we'll now zoom out, go a little higher level and more specific to personal to you.
Yeah. So again, throughout the year as well, thinking about what's changing in your life and how that ultimately affects your financial plan is really important. And probably one of the most important parts of a financial plan is that it's to constantly be monitoring, right? Thinking about your situation today, might be simply different than where it's going to be at in 6 months or 12 months, etc. So things to be thinking about as life changes, how that can affect many different avenues of your financial life and financial plan is paramount. So things like marriage or divorce. So making sure that your beneficiaries are all up to date, whether that's through your 401k or 403bs through work, whether that's through personal accounts outside of work, your IRAs, your checking and savings accounts. All these accounts is incredibly important to be listing who your beneficiaries are, and if you need to make changes to those, making sure you do that promptly.
You probably don't want your ex-spouse being the receiving money if you were to pass away, as a beneficiary in your accounts. And if you're newly married, your newly married wife, spouse, husband, what have you, probably would like to be the beneficiary and not, get your mom or dad off of being the beneficiary and maybe name your new spouse.
Exactly.
It's a nice way to enter the marriage.
Exactly. And in the same vein, also making sure, things like if you have a will, if you have trust, updating powers of attorney, pretty much any sort of family change, making sure those important estate planning documents are up to date across the board. If you happen to have a child, and you're thinking about saving for college, and we talked about, Trump accounts as one avenue of saving for a child, but 529 accounts are a very powerful saving tool when it relates to college as well, or even lower education now as well. So 529 accounts, opening up those, and depending on your state, you could also receive some tax deductions at the state level for those contributions. So important to look into the 529 plans if that's of importance. And as well as life insurance, as you have more people in your life that are relying on you, making sure life insurance, either not only the beneficiaries up to date, but making sure you have adequate coverage, in the event something ever happened to you or a loved one. Same idea, job or income changes as you have more income. Hopefully, maybe you're able to start saving more, utilizing some of those, powerful tax saving tools that we talked about. Maybe it's increasing, your 401k contributions, looking into other sources of savings. But as well as you receive more income, there's more tax consequences as well. So it's really important to revisit tax planning strategies, especially as we talked about, if you start getting closer to some of these income limits, making sure you're finding ways to minimize your tax liability when possible. And the same goes if something happens and you have less income, whether it's a change in job, taking some time off, whatever it may be, making sure that your savings is intact and you're continuing to build up things like your emergency funds, etc. And then on the health side, again, as life changes, things can also be affected on the health side of the ledger, making sure insurance is up to date, thinking about if your retirement age is going to change, are you on the path to retire at your retirement goals, can your money last throughout retirement, things like that is incredibly important. And then on the family health side, potentially looking into things like long-term care, if that's something that is of interest. Starting long-term care at a young age makes it much more cost efficient on your side if that's something you want to look into. And always thinking about a parent if you're going to need to be supporting them as well. Went through that pretty quickly, Chris, because I know we're getting short on time here, but feel free to add in anything as well.
Yeah, no, I think one of the things, wasn't listed there, but in inheritance, if you received an inheritance, particularly an inheritance of any retirement accounts, be mindful of that. That's going to have an impact on your planning going forward. Just milestone birthdays. Look, if this is a milestone year for you, here's some things to consider. Age 50, you can start making those catch-up contributions. Age 59 and a half, you can take distributions from your retirement accounts. without penalty. Age 60, you get that enhanced. Age 62, you can start Social Security. Age 67 is when you really reach full retirement age, and you can take your full Social Security benefit. Then if you're turning 73, you might have to take some required minimum distributions out of your retirement accounts. So those are some of the big kind of milestone years from a financial planning standpoint. And then just to kind of wrap up on a couple notes, one is, you know, if you're using some of the tools and calculators that are available through the 401k site or what have you to run projections on what your future is going to look like, you might just want to take a look at what assumptions you're using. There's an assumption made in there of what investment return are you assuming you're going to earn on your retirement accounts. Maybe you need to revisit that assumption. I'll say why in 1 second. Same thing with inflation. For prior to 2021, we had 20 years of inflation around 2%. Then in 2021, COVID happened and inflation kind of shot through the roof. So since then, inflation has been running closer to, on average, it's been over 3%, but currently we're sitting at about 2.7% per year. That means the cost of things that we buy on average the last year went up by 2.7%. And that's an important consideration when you're doing retirement planning, is how much is the stuff that I want to buy in retirement, how much is that going to cost in the future? So being cognizant of what your investment rate of return assumptions are and what your inflation assumptions are. On the investment return assumptions, let me just tell you, I'm going to get a little wonky here for a second. What we have seen over the last really probably 17 years, with the exceptions of some minor blips, is we've seen the stock market performance has been just kind of up and to the right. We've seen, upwards of the last 3 years just alone we're up double-digit returns for U.S. stocks. So what we're looking at, that means that the stocks are currently kind of expensive, and I'll just use the word expensive. And what you see here is that this diamond that you see. So historically, when stocks have been this expensive, over a 1-year period, we don't really know what they're going to do. You can see each one of these littler dots is what this 1-year market performance was. So it's kind of scattershot. It's all over the place. But if we want to think forward and say, well, what's the average return in the next 5 years when we're looking at valuations like they are today? So as you can see, now we start to get much more of a correlation. Things are much closer to this trend line here. And what you see is that the average return is much lower. So this left hand, the axis over here shows you what the rate of return is. And historically, it's clustered. We see a lot more outcomes where the average annual rate of return going forward from this level is lower. So point being, I don't think it's appropriate to plug into your investment calculations, assuming that we're going to continue to see, 15, 20% rates of return every single year. That's the anomaly that we've seen in the last few years. So I'll leave it at that. And here's where I'll wrap up. Look, we talked about on the outset about how complicated our financial lives are. But if we really want to simplify it and have actionable and not overwhelm ourselves, what we really need to focus on is financial planning is simple. It's where are you today? Take inventory of everything you have today. Where do you want to go? Where do you want to be 5 years, 10 years, 15, 20, 30, 40 years from now? What are your goals? And what of those goals, which ones need money, and how are you going to save? How are you going to financially be able to afford those goals? And that's what you're solving for. How do you get there? Here's where I'm at. Here's what I want to be. How do we get there? So we're going to spend time, like I said, today was just talking a little bit about 2026. We're going to spend time talking about breaking it down to give you the tools to get there. So you want to know where you are, you want to establish some goals, you want to create a plan. I've shown this the last few presentations, and I'm going to show it again. This is a tool that we have available to you that will help you aggregate. Remember, the first step, where are you today? This will help you look at everything that you have in one place, all of your accounts, your retirement account, your spouse's retirement account, your joint accounts, your mortgage, your house value, everything can be pulled in and you can see it all in one place. You can define some goals here and you can run some calculations to see how you're progressing towards those goals. So this is a tool that we offer to you as part of our services at no cost to you, that you can request. Just email us and request your own. We'll send you an email where you can set up your own secure username and password. This is not shared with anybody. And again, it doesn't matter if you use this tool or you use another tool. There's other tools that are out there that you can use. Our tool, it's available to you. It's at no cost. We don't share your information with anybody. You know, I always worry about those, you know, the mint.coms, the Quickens, the things that are out there. You know, they take your information, they get a lot of valuable information about you, and then that information can be shared with advertisers and what have you. So if you think this would be a benefit to you, please reach out to us. Continue to join us. I know we went over today. Continue to join us in the future. Next month, we're going to drill in a little bit more on just getting organized, how to organize your financial life, what documents you need, tools and strategies to start a budget, track spending, and run some, just to get yourself organized. April will be the end of the quarter. We'll do an investment market update. And then in May, we'll start talking about some of those goals. For some of you, one of those goals might be for paying for education costs for kids. So continue to join us in the future. We appreciate you taking the time today. And we hope that you'll reach out and request the tool or let us know if you want to talk one-on-one.